Good afternoon. Welcome to SACS's presentation of a COVID-19 update with regards to state and local taxes and the impact that the pandemic is having on state and local tax environment. Slide, please. Our firm provides this information in this webinar presentation for general guidance only and does not constitute the provision of legal advice, tax advice, accounting services, investment advice, or professional consulting of any kind. The information provided herein should not be used as a substitute for consultation with professional tax, accounting, legal, and other competent advisors. Before making any decision or taking any action, you should consult a professional advisor who has been provided with all the pertinent facts relevant to your particular situation. And I think that housekeeping note is important because this webinar is designed to give you ideas of issues that you may be encountering more so than solved issues that you may be encountering. My name is Kevin Soar. I'm a state and local tax specialist with SACS, and today we will be discussing residency and dual residency considerations, issues for sourcing income for telecommuting employees. That's something that maybe was never an issue prior to 6 months ago, but it's becoming an issue now. NEXUS considerations for employers with telecommuting workforce. State's fiscal positions, updates with respect to New Jersey's BAIT, that's the Business Alternative Income Tax for pass-through entities, and that new tax regime, and then time permitting, we will address questions and answers that you may have. Before we begin, let's do some housekeeping. Keep in mind that this webinar is eligible for CPE. But first, if you have any questions during the course of this seminar, please type in to the chat box associated with this with the browser. Time permitting, I'll get to your questions, and it is in the chat function that I will see your questions raised. The recording of this webinar and slide deck will be emailed to you tomorrow within 24 hours of the conclusion of this presentation. And again, if you wish to receive CPE, there's one CPE credit for this webinar. The following is required of you. You must stay connected for the entire duration of the presentation. There's no partial credit for the CPE. Successfully answer 3 out of the 4 polling questions throughout the presentation. When we say successfully answer, we mean submit your answer. If you get the answers wrong, that is not going to weigh against you. We just need to make sure that you're continuing to pay attention to the webinar. Download and complete the participant course evaluation form in the handout section of the webinar control panel. Then email that to jtose, J-T-O-S-E @sacsllp.com to receive your CPE credit. Your CPE certificate will be emailed to you within a few days of this webinar. And with that, I think we can proceed to the body of the contents of this presentation. So let's begin by talking about residency and dual residency. And first and foremost, why do we care? In ordinary times, a taxpayer with a tax reporting obligation in more than one state will pay tax where his or her income is earned, calculate a tax in his or her state of residence, then claim a credit in his or her residence state for the taxes paid to the state where the income was earned. This is the normal way that state and local taxes for individuals have functioned, and it continues to be. But facts have changed. Taxpayers, so now we're dealing with taxpayers paying net tax of the higher of those two, the resident or the source of the income. But what happens when the taxpayers' changed facts lead to more complicated outcomes? COVID-19 related changes to fact patterns regarding both living and working situations will complicate residency determinations, income sourcing determinations, and the application of credits for taxes paid to other jurisdictions. And that's where the risk of double taxation without the possibility of a credit offset will be increased. Okay, so there are 2 primary ways that a state will attempt to assert residency over a taxpayer. The first is domicile, and this is a very qualitative test. In general, I'll be speaking generally with an eye towards New York has guidelines on residency that's probably more developed than any of the other nearby states, but all the nearby states use the same general guidelines. So domicile is the place where an individual intends to be his or her permanent home. When the person is away from home, where is it that that person returns to? That is the domicile. And when that test is being employed, when we are undergoing a residency audit and we're talking about domicile, the auditors get very personal. They ask questions about your children. Where do they go to school? They ask questions about your professional service providers. Where do you see doctors? Where do you see lawyers? Where does the taxpayer keep items near and dear to their heart? I hate to use those near and dear because it sounds like a cliche, but it is actually a term of art that's used by the states to help them identify where it is that your true home is. Taxpayer, this is important. A taxpayer's domicile is presumed to be unchanged until he or she does something to affirmatively create a new permanent domicile in another location. What does that mean? It means vacating your home for a temporary, even if it's a prolonged time, for a temporary amount of time is not enough to lose your domicile. You must actively take steps to create a new domicile in a new location if you want to abandon residency in the state where you're traditionally domiciled. Slide, please. Okay. The second way that a state will try to attach residency to a taxpayer is by way of statutory residence. Now, remember we talked about domicile, and that's a qualitative test. That's a touchy-feely sort of determination. Statutory residency test is not that at all. Statutory resident of a state is someone who maintains a permanent place of abode for substantially all of the year and enters the state for 183 days that year. So it's just math. If you are in the state for 183 days and you have a permanent place of abode, then that's the test. Auditors at that point are not willing to engage in discussions or arguments about what's fair. That is the test. This is something to keep in mind and might be applied to some of the taxpayers listening today. What is a permanent place of abode? Permanent place of abode is a home suitable for year-long living where the taxpayer has access for substantially all of the year. Now, New York, in their audit guidelines, they suggest that substantially all of the year means a home where you have access to the home for 11 months out of the year. Every auditor you meet will tell you that they don't actually limit themselves to that guidance, that if you own a home for 10 months or something else, they will say that that's a permanent place of abode. But that's the sort of guideline that we deal with. And when we say that it's suitable for living for substantially all the year, we mean that summer camps without working heating in the Northeast, that's an example of something that can never be a permanent place of abode. And again, this I want to stress, there's nothing in the COVID-19 guidance that's come out from the states that said the 183 days test is relaxed. It is not. The states are anxious for money, and it's strictly a math test. If you have the home and if you have the days, you're a statutory resident, and then that becomes very difficult to argue your way out of. Slide, please. There are some exceptions to the day counts. And when I say exceptions, keep in mind that these are very difficult to qualify for exempt days. For example, medical care may be exempt. Travel days through the state may be exempt. But when we say medical care, what we really mean is inpatient medical care. That means that if you are admitted overnight to the hospital, your day will not count. If your spouse visits you in the hospital that day will count. When I say that travel is exempt, travel is exempt. If you live in Connecticut and you are traveling through a New York airport, and all you do is drive from your home to the airport in New York, that day should not count. But if you stop for dinner along the way and you have dinner before you hop on the airplane, now we have another discussion, and that they probably will count. So just keep in mind, there are exceptions to the day count, but they are very difficult to satisfy. The other thing to keep in mind is how auditors seek to audit this issue. There are many tools that they look to see where you are. They look at credit cards, they look at bank cards, they look at Easy Pass, they look at a lot of information. In my experience in recent years, the most compelling piece of information every taxpayer owns is their cell phone. And I know I don't look at my cell phone records with any regularity. It's a fixed price, I pay it monthly. But I can tell you that the cell phone records provide a very, very detailed view of where you are and where you've been every day. So that's really, and the other thing that I want to highlight, they offer this as a courtesy when the audit begins. Every auditor will inform you that yes, you will be entitled, if you cannot provide your cell phone records because you don't have access to them or you don't know where they are, don't worry, they can subpoena them for you and do you that favor. So just keep in mind, this is not something that's taken lightly, and your cell phone records are probably more revealing than you might imagine them to be if you haven't looked at it in detail. Slide, please. Okay. Now, getting into the meat of the mechanics of this credit, of the problems with being a potentially a dual resident, is the resident credit for taxes paid to another state are designed for earned income. For example, if an individual works in state A but resides in state B, that is the fact pattern where the credit is designed for. The individual in that situation will pay tax on the income that's earned in state A, which is all of it. The individual will report that tax to state B. They will report tax in state B, their resident state, on the full amount of income that's earned, but then they will receive a credit for the taxes paid to the other jurisdiction. So the individual, in essence, pays the higher of those two tax rates in full. Slide, please. What this doesn't account for is unearned income. I'm talking about capital gains, dividends, interests. Some states do have mechanisms in place to account for this, but it's not nearly as universal. Earned income should be credited. Unearned income is a whole new argument, and states insist that if you are a resident of their state, you did not earn your capital gain in another state. You're a resident of your resident. They want to tax that income, and if your taxpayer's income profile consists substantially of unearned income, capital gains, dividends, etc., this is the taxpayer that perhaps at greatest risk of paying double taxation on their income for this amount. I do want to note, though, that New Jersey has an uncommonly broad credit for its resident taxpayers. And there they simply say that if you pay tax in another jurisdiction on this item of income, they'll grant you a credit. But again, I want to stress that New Jersey is uncommonly generous, and perhaps even unintentionally generous with that statutory credit mechanism that's in place. That's not common to do. Slide, please. Okay. Now, in addition to the uncertainties with how the credits will apply to unearned income, COVID-19 has shaken up everybody's fact patterns in such a way that I think we're probably going to encounter uncertainties with how credits apply to earned income. And maybe the easiest way to illustrate this is by the way of an example. Continuing with the example before, an individual works in state A and resides in state B, and during that pandemic, the individual taxpayer telecommutes from his or her home in state B. Now, where does that individual earn his or her income? Is it in state A where the traditional office is, or is it in state B, where that person has been performing his or her duties for the past 6 months? I will tell you that states will not have a uniform interpretation of this question. They just won't. Now, another thing that might be a familiar term to you in the audience is the convenience of the employer test. And that's a test that many states have, especially in the Northeast, which says that an employee working from home for convenience's sake is regarded as working from his or her regular office for the purposes of sourcing income. Now we're in a pandemic, and there's been state mandated lockdowns that all offices have been complying with for the past 6 months. So what to do in that situation? My office is in New Jersey, and I've been working from my home in New York for the past 6 months. And if I've earned my income from my traditional office, or have I earned it from my home? That is an open question. Not many states are addressing this, and the answer will not be universally the same. So there is a possibility that the home office state will say, well, that's a day that you worked in our state, that's income earned here. And there is a possibility that your office state will say, well, this is really something that should be sourced to your regular source of business. States, particularly New York, have been aggressive in the past in claiming that the convenience rule applies even in extraordinary situations. Slide, please. Okay, so I think maybe the best way to go through some of these issues that taxpayers are going to see is to go through some hypothetical examples. So let's look at an example here. This is Joe is a retiree domiciled in Manhattan's Upper East Side with significant capital gains. He also has a home in the Hamptons out on Long Island that he's traditionally using for summer use. So Joe vacated his home on the Upper East Side to escape the corona hotspot in April, and he went immediately to his summer home in the Hamptons. Joe has not sold or rented out his Upper East Side home and plans to return to New York City when the pandemic passes. Joe will not spend 183 days in New York City for 2020. So the question is, what are the residency considerations that Joe should be willing to address? Joe in this situation is a New York State and a New York City resident. He's domiciled on the Upper East Side, and he's taken no steps to break that domicile. And his absence, even a prolonged absence, even an indefinite absence, is not sufficient to break domicile. So in this case, Joe will continue to be a New York City resident. Slide, please. Ooh. Okay, time for a poll. And for this, remember, you must answer 3 out of the 4 polling questions in order to receive credit. The NFL East includes 4 football teams: Dallas, New York, Philly, and Washington. So far, they've each played 4 games this year. In total, how many games have these impressive teams won over the course of the first 4 weeks of the season? Now, I'm not asking how many has each team won, but just in total, how many has the total of these 4 teams won? So give you a few seconds to take your best guess. All right, get your polling questions in. Okay, great. It looks like we have a lot of football fans here because, yes, the NFC is terrible this year, absolutely terrible. As a longtime fan of the New York Football Giants, it gives me no pleasure to tell that they've contributed exactly 0 wins to that 3-win total. All right, let us proceed. All right, now let's consider some more examples. Just because, and again, I think the examples are the best way to kind of illustrate some of the nuances that taxpayers should prepare themselves to address as they get through their own residency issues. So in this case, Joe is a retiree, same example as before with some small exceptions, except this time he's domiciled on the Upper East Side, again with significant capital gains, but this time he summers in Martha's Vineyard. Again, early on in the pandemic, Joe leaves his Upper East Side home to weather the pandemic at Martha's Vineyard. He has no intention of selling or renting his Upper East Side home, and he will return to New York City when the pandemic passes. So Joe will not be in New York City for 183 days this year. So what are the residency issues Joe needs to be aware of as he prepares his 2020 returns? Joe will be a resident of New York State and New York City for the year. He's domiciled in the state. His long-term absence from the state is insufficient to create a new domicile. Absence alone is not sufficient to break domicile. So he will be a domiciliary in New York and state and city and pay taxes there. Next, Joe needs to track the days that he spent in Massachusetts for the year. If he is in Massachusetts for 183 days, he will be a statutory resident of Massachusetts. And note that the question is just that. How many days does he spend in Massachusetts? The question is not how many days does he spend at his Martha's Vineyard home. He could be in Worcester, he could be in Boston, he could be in the Berkshires. It doesn't matter. A day in Massachusetts is a day for residency purposes, even if you're nowhere near your vacation home or your permanent place of abode. So that will be the test that Joe needs to consider. Now, if he determines that he spent 183 days in Massachusetts, he will have additional questions to ask himself. Will he receive a credit for taxes paid to New York on his Massachusetts return? Conversely, will he receive a credit for taxes paid to Massachusetts on his New York return? That's the question that he needs to ask. Need a little bit more information to dive into that. I don't know the answer in Massachusetts. I wouldn't be optimistic that New York would be very generous here. So, but that is the question for Joe. Slide, please. All right, let's change gears a little bit. Jane resides and works in Stamford, Connecticut, and in March, after the pandemic outbreak, Jane, seeing that the pandemic was going to be a big alteration to her lifestyle, decided to rent a year-long home in Montauk to weather the lockdown conditions. So first thing we got to talk about is domicile. The residency, again, the residency is two tests, domicile and statutory. Jane will continue to be domiciled in Connecticut until she actively creates a new domicile elsewhere, and her renting of a home on Long Island is insufficient to break domicile. So Jane should be prepared to pay full income taxes in Connecticut. Next, Jane will be in New York for more than 183 days. That sounds unfavorable, but remember the test. Must maintain a permanent place of abode for substantially all of the year. And recall our fact pattern, Jane only entered into this long-term rental agreement after the outbreak in March. New York has the 11th month rule. Again, they don't hold themselves to it, but if anything short of 10 months, I've never heard them going strongly after. So in Jane's situation, I think it would be wise for her to say that she is not a statutory resident. She did not have a permanent place of abode within the state for the period. But then the next question she must ask herself, will New York consider the days that she's been telecommuting from her Long Island rental apartment? Will New York consider that to be income earned in New York State? That is the question for Jane. Slide, please. Yes, thank you. All right, one more example. Mitch is a longtime domiciliary of New York with plans to retire to a longtime vacation home in Florida. In March, Mitch drives to Florida to escape the COVID-19 hotspot. In April, he commits to activating his long-term plan of relocating to Florida permanently. He places his New York home on the market for sale. These are exactly the steps that you want to see a taxpayer begin to take in order to break domicile. Mitch should treat himself as a part-year domiciled resident in New York for the activity up until the date that he breaks domicile. Some of the other things that Mitch is going to want to do in this situation in order to create the new domicile in Florida. Selling the home is very important, but it is insufficient. The other things, all the registrations that you have with your licenses and with your cars, if you have a boat, where you vote, all these things must be completed. They're not sufficient to break domicile, but they be very difficult to convince an auditor that you really broke your domicile if you're reluctant to do those things. Slide, please. Okay, CPA poll number 2, CPE poll number 2. All right, let's see how good we are with our language here. A mongoose is a small mammal. And what is the plural of the word mongoose? Some options: mongeese, same way you would pluralize the word goose. Mongoose, like a moose. Mongoosen, like the plural of ox. Mongeise, like mouse. Or mongooses, like any other common noun. And we'll open that up. Again, get your polling questions in before the time rolls. Your questions need to be submitted. They do not need to be correct. Wow, it's an interesting display of guesses here. 30% is correct. Mongooses is the correct way to pluralize the word mongoose. And yeah, I guess there are more people familiar with those animals than I would have anticipated. 30%. That's pretty good. All right, let's go over some other items. Again, so when we're talking about changes to state and local tax presentations, there are two things that that really strike your attention. One is when you have a change in facts, and the second is when there's a change either in the law or in the guidance that the departments of revenue issue, which show how the departments expect to enforce those laws. As a result of COVID-19, I feel like we're getting both of those things really in lump sums. Where taxpayer facts are changing, and the guidance coming from the states is changing, and it's not always in the consistent manner. The states aren't working in unison here. So let's go through some of these things that we want to address here for the telecommuting employee and where he determines that he earns his income. So telecommuting employee ordinarily works in an office location 5 days a week, and for the past 6 months he's been working from his home office. Taxpayers like we said earlier, the primary state to pay your tax is to where the tax is earned. And the secondary reporting obligation is to the resident state, where you can then attempt to claim a credit for taxes paid to where the income was in fact earned. So what's going to happen now that employees have been telecommuting? Some states instruct taxpayers to source the income to the home office. Some have instructed taxpayers to continue to source their income as being earned at their ordinary business location, essentially assuming the counterfactual that the COVID-19 did not exist and you've been working at your regular office for the past 6 months. Most states haven't said anything. And there we need to consider, does their silence indicate that they plan to go ahead with their ordinary rules, which would essentially be the home office, or does it push back to a convenience test? I talked about the convenience test earlier, and it's quite common in the Northeast. If an employee is working from home for convenience's sake, the state will say source that income to their regular business location. New York had a famous case with this where a law professor from Yeshiva University actually baited the case. He created his own fact pattern where he was a professor in New York City, but 2 days a week he worked from his home and grading papers and preparing lectures. He lost that. He tried to say that he worked 40% of the time in Connecticut at his home. He lost that case. New York said, you're working from home for your own convenience. And ever since then, New York has been very, very aggressive. Now, frankly, they were aggressive before then, but they've been aggressive in saying that if you have a standard business location in New York, that is where you're earning your income. And if you're occasionally absent, that is probably for your own convenience, and they'll just consider it as a New York day. Now, those are the general rules. This is the first time where we've had a 6-month limitation on how offices are permitted to be open. And does that change our outcome? This is where it would be very helpful if the states would issue guidance, but frankly, most states are not addressing this, and that creates the uncertainty that we're presently dealing with. Slide, please, Margaret. Another thing that taxpayers are going to need to address. This is maybe more on the business side of things. In ordinary time, taxpayers create nexus through their employees and through their properties and through their sales. And for the past 6 months, we've had employees telecommuting either from their home residences or from their vacation homes or from anywhere. Frankly, we might not even know where people are telecommuting from. So does the telecommuting employee create nexus in a state for his or her employer? Ordinarily, the answer would be yes. If you sit from home on a regular basis and you're working for your employer almost certainly has nexus in that determination. Some states, shortly after the COVID-19 travel restrictions and office restrictions were put in place, some states put out guidance saying that temporary work from home orders will not create nexus to the employers. Some states were silent, and we don't know whether or not that silence should be taken as a sign that they're agreeing with the majority of states who have spoken on this and said, yes, these temporary restrictions, these temporary work adjustments should not create nexus, or does their silence just mean that their normal rules are in place and that the temporary, an employee working from home is in fact creating nexus? We'll need to see how that comes out, and it might be some years before that gets tested. New Jersey is one of the states that was very quick to say that changes to your fact pattern because of telecommuters will not create nexus for their employers. Slide, please. Now, this also creates an issue because when the states that address this, they address this in March, they addressed it in April, they addressed it around the same time that they were granting relief for your 2019 tax deadlines and tax payment obligations. Basically, it happened at the start of the pandemic. Did they know that people would still be telecommuting in October 2020? Or for however long this will go on? When we have a permanent change in facts, will that lead to a permanent change in our outcome? So in addition to that guidance, right, some states issued guidance saying that temporary work from home orders will not create nexus. But when does that guidance end? Imaginably sometime, if not October 2021. But what about the other thing? The guidance from the state has changed, but what about our changes in fact? If that employee over the past 6 months has discovered that he's quite productive at home, much more productive than he had imagined that he could be, and decides that going forward, after the pandemic breaks, work is back to normal as can be, and he decides that 2 days a week he's going to return to working from home. If the temporary work orders are lifted, and they hopefully they will be by March of 2021, you would think that the change in fact pattern, which became permanent, will then lead to a change in our outcome, which would be a nexus determination. Slide, please. Okay, perfect. Poll number 3. Remember, you need to answer 3 out of these 4 questions. None of them need to be right, but you do need to answer them 3 out of 4 to get your CPA. In the 80s, the Highwaymen were a country music group and included 4 individual country stars. Who was not a member of the Highwaymen? Waylon Jennings, Johnny Cash, Merle Haggard, Willie Nelson, Chris Christopherson. This will be a test both of your musical tastes and your age. Or maybe neither. Okay, last chance to get your polling questions in. Wow. Good to see that the answers are spread along the board. Merle Haggard is the correct answer. Merle Haggard was not a highwayman. It was a lot of things, but the hag was not a highwayman. Okay, so in addition to changes related to COVID-19, there are some other changes that are pertinent to our local taxpayers that we need to address. We want to address. New Jersey BAIT update. And for the past few months, we really have not had an update on the BAIT. And let's review what it is exactly, what this BAIT is. In the early part of this year, New Jersey put into effect an elective tax on pass-through entities, and they titled it the BAIT, the Business Alternative Income Tax. The purpose of the BAIT is to find a workaround for the federal limitation on state and local tax deductions at the individual level. You'll recall that individual income taxes at the federal level, state taxes the state tax deduction is limited to $10,000. So this is designed in essence to make it a deductible tax expense at the entity level, and then let the members or partners of that pass-through entity enjoy the credit for taxes paid on the gross income tax return. So, as I said, this was implemented before the pandemic. They were short on guidance when they implemented it, when this became effective. It's effective for tax years beginning on or after January 1, 2020. So they've been very late in providing guidance. But after silence just this past week, 10 days, the divisions issued guidance on the application of the BAIT by way of a new frequently asked questions page, and also by way of making it now permissible to make online prepayments. So here are some of the takeaways that taxpayers considering the BAIT should keep in mind. The BAIT is an elective taxpayer election that's for tax years beginning on or after January 1, 2020. The state will not impose this on you. Who are the eligible taxpayers to make this election? Partnerships, federal S corps with a valid New Jersey S election, and multi-member LLCs. Single-member LLCs and sole proprietorships cannot make this election. All right, some of the mechanics of the 2020 year. There's no penalty for failure to make estimated payments for the 2020 year. They've only recently permitted that payment in the first place. So they've issued guidance that said everybody's under the safe harbor based on last year's tax liability, which was 0. There should be no penalties for failure to make estimated payments for 2020. The division has enabled online estimated payments. So again, even though there's no penalty for failure to make the payment, the whole purpose of this is to create a deduction for federal income tax purposes. So we encourage cash basis taxpayers to make payments to qualify for that 2020 deduction. This is another interesting thing that came up in the FAQs, New Jersey will honor credits to resident taxpayers for the Connecticut pass-through entity tax on the New Jersey resident gross income tax returns. Sounds like a mouthful, but Connecticut basically has a similar, it's different, but it's a similar pass-through entity tax regime. New Jersey's saying that it's acknowledging the taxes that flow through to members and partners in that system are going to enjoy a credit for on their resident gross income tax returns. Slide, please. Okay, this is simply the graduated tax rate for the BATE. The first $250,000 will be taxed at 5.68%. Up to $1 million will be at 6.52%. Between 1 million and 5 million at 9.12%, and income over 5 million will be taxed at 10.9%. As you can see, these are substantial rates. Slide, please. Okay, maybe the best way to illustrate the mechanics of this is by way of an example. And this is an example that's actually included in the FAQs, but it's illustrative. Pass-through entity AB has 2 resident members with 1.5 million of income that is sourced 60% to New Jersey, resulting in 900,000 of New Jersey source income. All right, it's important to realize that this is an apportioned tax. It is not paying tax on the full amount of the pass-through entity, just New Jersey source income. Each member receives 50% their ownership share in the partnership share of reporting $450,000 of New Jersey source income to each member. Using the rate schedule that we looked at above, partnership AB will report 56,000 and change in tax, and each of the 2 members will receive exactly half of that, 28,000 and change. And then they will claim on their New Jersey gross income tax returns, they will claim that credit against their gross income tax liability. If they discover that they've, as a result of this credit, they're overpaid, this is a refundable credit to individuals. If it's a corporate partner, it is not refundable, but it is carried forward for future years. Now, this last bullet here is really why you're doing this. AB will claim a deduction on the federal income tax return for the state level taxes paid, and the limitation applied to individuals is not, remember the $10,000 limitation for state and local tax deductions on the individual income tax return, that is not applicable to these business entities. Slide, please. Okay, there are 2 main uncertainties with respect to the BATE. Will the IRS honor the deduction? The IRS have previously voiced opposition to state-level workarounds fashioned to avoid this limitation. The IRS has not addressed this fact pattern. It's not yet ripe. I don't know when they will, but it is an open issue. And 2, will neighboring states, or really any state, honor a credit for its resident individuals for the BATE paid at the entity level? Most states are silent. This is what I talked about earlier when New Jersey said that they would honor the Connecticut credit by them actually specifying that they'll honor the Connecticut credit. They're kind of hinting that they understand that this is not a certain position. Remember, the taxpayer is entitled to credit for taxes paid to another jurisdiction. But using our example of partnership AB and partner A, does partner A really pay tax to New Jersey when he receives, or is it really a partnership tax? That's really the issue, and that's the uncertainty, and we don't know how other states are going to adopt it. One important, let's talk about some other items here. Political forecasting is always difficult. I'm not a political forecaster. There are some politicians for whom this SALT limitation has been a key voting issue, and some politicians are particularly anxious to have this overturned or to adjust the federal limitations to make it like it had been, unrestricted. With the federal elections at the House and the Senate and the White House, will there be enough support to reduce this SALT deduction limitations altogether? in which case this planning opportunity could be moot. Something to think about. It's not something that we handicap, but it is something to think about. There is a chance that this planning opportunity might resolve itself. And again, remember I said that Connecticut has a similar tax, but it is importantly distinguished in one way. It is a mandatory tax. To the extent that New Jersey offers an elective tax, there is a chance that it might be regarded as less of a tax than the Connecticut tax. In which case it might hurt these two uncertainties above, might hurt Connecticut's position, I'm sorry, New Jersey's position relative to Connecticut with respect to those two uncertainties. Slide, please. Okay, this is the final polling question, and I will encourage you to answer. Remember, you need to answer at least 3 out of the 4 polling questions in order to receive your CPE. In 1947, Bob Cousy, Boston Celtic great, played on this NCAA championship basketball team. Where did Bob Cousy play and win an NCAA championship? NYU, St. John's, Boston College, Holy Cross, or Villanova? Get your polls in. Wow, spreading around, he is a New Yorker, but only 27% got it right. He is Holy Crosser. So congratulations to those of you who got it right. All right, some closing items. Governor Murphy signs New Jersey updates in particular. Last week, Governor Murphy signed the budget, which included several tax increases. Corporate business taxpayers will see their surtax increased for taxable income above $1 million. There has been a surtax in place for the past several years. It was scheduled to be reduced to 1.5% during the present year, and then eliminated for 2021 and beyond. The surtax is now extended until 2023 at the full 2.5%. Keep in mind, this is a retroactive tax increase. This is for the present year. Taxpayers in this situation should have been planning to see a 1.5% surtax on their income tax liability. Now they need to recalculate it presently for 2.5%, and again forecast for their next several tax seasons to be at the higher rate, including any rate that they need to apply to their cumulative temporary differences or time guide. The division said that they'll waive penalties for underpayment of estimated taxes resulting from this retroactive tax increase. Okay. In addition, there have been adjustments or increases to the millionaire's tax, which was always up until the other day, the millionaire's tax was always misnamed. Previously, the increased rate of 10.5% only applied to income over $5 million, so it was a $5 millionaire tax. As a result of the budget, this new rate applies to the $1 million of taxable income. This is important. Same thing, they are not looking to make penalties on, this is a retroactive tax increase. They are not looking to penalize underpayments, but at the same time, they are looking to catch up on payments which were not made to capture this increase. So what they're doing is for the final quarter of the year, if you are in that window of, if you or one of your employees or anyone with a withholding obligation on income between $1 million and $5 million, the withholding rate for the final quarter of this year has been increased to 21%. That's right, 21% withholding rate in New Jersey for the final quarter of the year to make up for this, to help to make taxpayers fully paid in before the conclusion of the year. Slide, please. Okay. Now, right when this pandemic hit and the work from home orders were in place and everyone was getting used to a new way of life, many of the states issued relief. That relief was extending deadlines for payments, extending deadlines for tax returns, sometimes even extending deadlines on statutes of limitations. They issued relief in the way of no nexus telecommuting rules. But in more recent months, states are expressing just straight fiscal frustrations. Pennsylvania, New York, New Jersey, they're all in bad fiscal shape. And what I want to encourage taxpayers to do is don't think that their early relief or their early efforts to try to help taxpayers is going to be following through. And, you know, yes, it might seem unreasonable to taxpayers to pay taxes in 2 states. And maybe, in fact, it is unreasonable. But if you're a statutory resident, I don't want to encourage you to think that states are going to be turning some sort of generous cheek for you to say, you know, these are extraordinary times, and they're not looking to punish taxpayers. I don't get that sense from the states at all. If anything, I get the sense that the states are looking for new avenues to raise money, and if they have an influx of new, relatively wealthy residents who own a second home in their state, and because it's their second home and not their primary home, they don't vote in their state. Yeah, states have been looking to raise taxes on out-of-state taxpayers ever since I've been doing this work. So yeah, I really encourage people not to think that there's going to be some sort of relief, because that's perhaps unlikely. And slide, please. Okay. Okay, so that concludes my presentation. I hope you enjoyed it. Let me take a look and see if there are any questions here. I don't know whether or not this qualifies for enrolled agent credits. I don't know. I do have another question from another channel. Are there any other state taxes that are being discussed? And there are. And again, this gets to my last point, which was the frustrations that states are experiencing on the fiscal level. Exit taxes are really something that no state, as far as I know, has actually passed it yet, but states are trying to impose or considering imposing taxes on long-term residents who are seeking to leave their state with built-in unrealized capital gains. So if that is your portfolio, you're a long-time resident of a state with plans on moving at some point in the future to a friendlier tax jurisdiction, realize the gains in that friendlier jurisdictions. Some states, including states in the Northeast, including New York, New Jersey, Connecticut, are openly discussing the possibility of tax on unrealized gains on taxpayers as they're exiting the state. California, I don't know if this had any traction, but California was considering a net worth tax on their taxpayers, and the net worth tax would even be applied for the 10 years following a resident's departure from the state. So if you were a resident of California and you were to leave California, California would seek to impose a net worth tax on you for the ensuing 10 years. Again, that hasn't really had traction, but those are the sorts of ideas that are being bandied about. And I think these sorts of ideas are extraordinary. And the very fact that this is where the discussion is probably should highlight to you just how desperate these states may become in the ensuing years. They might have been generous in March and April, but when that tax return is audited 2 or 3 years from now, I'm not sure how generous that they're going to be. And I really would encourage taxpayers to be diligent in counting their days and not putting this to the test. And with that, I think I would like to conclude this. If you have any questions that I did not answer, please email your questions to us. We'll get back to you as soon as we can. And we continue to ask you to visit SACS's COVID-19 Resource Center, found at sacsllp.com, to register for additional webinars and for ongoing information and resources. I can tell you that the PPP webinars have been regular and very informative, so I encourage you all to look through those. And the upcoming webinar is the impact on healthcare private equity transactions tomorrow morning. It's not too late to sign up. And with that, I want to thank you all for your attention, and I hope this has been informative, and please email with all questions. Thanks very much.